Okay, hi everyone. Welcome to today's webinar, Fiscal Sponsorship, Leveraging Your Organization's Creativity and Energy. My name is Jason Q. I'm a staff attorney at the DC Bar Pro Bono Center. So a little bit of information about us. The DC Bar Pro Bono Center is a DC-based nonprofit. We match nonprofit organizations with pro bono legal counsel. The pro bono attorneys help with many different types of legal issues, including corporate governance, IRS compliance, employment law, real estate, IP. We also host legal clinics to assist clients with specific issues, such as corporate governance or risk management or intellectual property. And finally, we sponsor trainings, webinars, and podcasts, like today's event, on important legal issues, and we provide written resources and archived webinar sessions on our website. And the link is there. Okay, so today's webinar, this is what we're going to cover today. We're going to ask the big questions. What is fiscal sponsorship? Why is it used? And then we're going to dive a little deeper into 5 key issues that people should be thinking about when they're creating their fiscal sponsorship arrangements. So the first 4 are sort of IRS-focused compliance issues, legal issues. And the last one, emphasizing the importance of having a written fiscal sponsorship agreement. In that section, we'll go into some of the more operational issues to ensure, things to think about to make sure that your fiscal sponsorship arrangement runs smoothly, and issues to think about to preempt problems down the road. So there's a function in GoToWebinar that should allow you to type in questions during the presentation. And hopefully we'll have time to answer some of those as we move along or at the end. But if you still have questions after the webinar, or if we can't get to your question, feel free to email me directly. My contact information is going to be on the last slide. All right, so let's start. Let's start with those big questions. The first one, what is fiscal sponsorship? So for the purposes of today's presentation, we're going to define fiscal sponsorship as a funding practice wherein established 501c3 nonprofit organizations, known as sponsors, provide support, including receipt and management of tax-deductible contributions to charitable groups or initiatives, or sponsored projects, which lack their own 501c3 status. This kind of arrangement has been referred to using other names in the past. You might have heard the term fiscal agency, but that term is not preferred. As we'll talk about later in the presentation, the fiscal sponsor must be in a position of oversight and control, must take a very active role in managing the sponsorship relationship. So if we were to use the term fiscal agency, that might imply that the sponsor is an agent of the sponsored project, and that's exactly the opposite of what the relationship should look like. So we're going to avoid the term fiscal agency. Another housekeeping note is that there are other fiscal sponsorship-like arrangements that are outside the scope of this definition. For example, maybe both the entities are 501c3s, but one is still providing kind of sponsorship and support to another. Those are much less common, and they're not the focus of today's presentation. We're going to go with the classic model here. So what are the benefits of fiscal sponsorship? The fiscal sponsorship is a really useful tool for getting small or startup charitable initiatives off the ground. So let's say you have a great idea for a new social services organization, and you've identified an unmet need, and you have a really novel approach for meeting that need. You might want to start a full-scale 501c3 nonprofit down the road, but right now it's just you and some friends, and you're in the very early formative stages. At this point, pursuing a fiscal sponsorship might offer a lot of attractive benefits. So what are those benefits? Well, we have some here. Now, first and foremost, it'll allow you to receive tax-deductible donations transmitted to you via your fiscal sponsor without having to form your own 501c3. So many donors and grant makers will only give to 501c3 entities, maybe because they want the tax benefits of doing so, or because there's just a level of comfort and familiarity attached to working with established 501c3s. A fiscal sponsorship gives you the ability to give that benefit to your donors, but without the upfront and ongoing costs of establishing an independent 501c3. So those costs include the application process and the fees associated with filing with the IRS. They include forming a board of directors and maintaining that board of directors and having governance structures in place for your board. It also includes periodic reporting to the IRS and to state agencies. Then with that second point on the state side, it also means you can avoid state and federal registration and reporting requirements, including charitable solicitation registration, by operating through your sponsor. So those are some of the burdens that you can avoid. Another big benefit, though, is that the sponsor can provide a lot of other supportive services. So they can provide administrative and technical support, including payroll and HR and benefits, accounting, insurance. They can help with their tax filings. They can provide office space, furniture and equipment, and they can also provide kind of general business advice and serve in a counseling capacity. And finally, a big benefit is that this is a very flexible arrangement. The project can operate exclusively as a sponsored project for its lifetime, or it can apply for 501c3 status down the road at an appropriate time. Because the fiscal sponsorship is created through an agreement between the sponsor and the sponsored project, you can build in flexibility into your arrangement. That's another big benefit. So then what are the benefits for sponsors? Well, for sponsors, it's a great way to amplify your impact and to advance your mission. Instead of running all of your programs directly, you're serving in a more supportive capacity for allied groups. This can be especially useful for testing and accelerating innovative ideas or creative ideas within your field without having to invest and develop the project in-house. If there's already a group, a third-party group that wants to do it, you can just partner with that group and support the group. And finally, to the extent that there are costs associated with the fiscal sponsor, and to do it properly, there are always costs, you can offset those costs by charging the project an administrative fee so that the work becomes financially sustainable for the sponsoring organization as well. So in the next few slides, I'm covering some kind of categories of common fiscally sponsored projects, just to flesh that out. The first one is the big one, these kind of incubation stage projects. Maybe they're newly formed, maybe they're proof of concept. They could even have their 501c3 application filed, but they're pending. They're waiting for the IRS to act, and they want to accept donations and start their activities ahead of time. There are organizations like TIDES and other fiscal sponsorship-focused organizations that work extensively in this space, that have being a fiscal sponsor as a core part of their mission. So the second category are time-limited or one-time projects. Maybe you want to renovate a theater or a school, or you want to hold a special event, or your project itself is time-limited, like you just want to do something for 2017. In these cases, it might not make sense to create a freestanding 501c3, and it might make more sense to partner and to become a fiscally sponsored project with an existing organization. The third example is emergency relief or disaster response. Back in September, we had the Hand in Hand telethon, for example, which was for hurricane relief. They raised over $55 million. You might have been wondering, is that a new nonprofit? The answer is no. It's a fiscally sponsored project, sponsored by Comic Relief, which also does the Red Nose Day and some other projects like that. So that's a great model for that kind of initiative. Some more categories: coalitions, joint ventures, and consortiums. So when existing organizations want to get together and collaborate and work collaboratively, it often might not make sense to create another organization to do that, especially if one of the member organizations is willing to act as a fiscal sponsor. International projects or projects located or working abroad might not be eligible to become domestic 501c3s, but a fiscal sponsor with an international focus can partner with those projects and accept tax-deductible donations and then re-grant them out to the international beneficiaries. So a sponsor like Global Giving works in that space. We also have individual or small-scale projects. So for filmmakers, artists, authors, other kinds of content creators, very often it doesn't make sense for them to form their own nonprofit organizations. So if they still are doing sort of charitable work or 501c3 exempt type work, and they want to receive grants or donations, they can fall under a fiscal sponsor that can be sort of a charitable umbrella for those kinds of initiatives. So for example, Women Make Movies has this fiscal sponsorship program for women filmmakers. So those are some examples. And we should note that kind of operationally, the structure of the sponsor-project relationship can vary, and there are sort of two common forms or two common models, and they're sort of on opposite ends of a spectrum. On one end, we have this direct project model, where the sponsored project has no separate legal entity at all. The project personnel are employees of the sponsor, and the project itself is a program of the sponsor. So this is a high degree of sponsor involvement and support. The sponsor bears a lot of liability here. On the other end, we have kind of a grant-regrant model. Here, the sponsor is a separate legal entity. It just lacks the 501c3 status. Sponsored project, I'm sorry. And the sponsor's main role is to solicit and disperse the third-party funding. So the sponsor essentially re-grants the outside funding to the sponsored project under a pre-existing agreement. So it's essentially a grantor-grantee relationship. The sponsor may provide other support services. Now, we see a lot of potential sponsors looking at that second option, the grant-regrant model, and thinking, well, that sounds great. That sounds like it's less involvement on my part. Maybe there's fewer legal requirements, and maybe there's lower risk. But we should know that kind of from an IRS perspective, there's a higher risk of abuse, and these models might be more subject to scrutiny. The idea here is that because the sponsor and the sponsored project are not working kind of hand in hand on a daily operational level, there's a higher risk that the sponsor will just become a conduit for tax-deductible contributions that don't end up ultimately benefiting a charitable purpose. And for the IRS, the only entity that they have oversight over and that they've pre-screened and that they're familiar with is the sponsor. So if the sponsor is now working kind of at arm's length with a sponsored project, the risk for abuse is much higher. So in the grant-regrant model, the sponsor still must exercise oversight and control to ensure IRS compliance. And that's going to be the main theme throughout today's webinar, are the sponsor's duties to exercise oversight and control. And so I just want to say that we're not going to get too in the weeds of what these operational differences might look like. But I want to say that the legal considerations that we're going to talk about today apply to both models. Okay, great. Let's see. Let's take a look at questions. How are we doing? Okay, awesome. Okay, so let's get into those big sponsorship considerations. These are the 5. As I said, the first 4 are sort of compliance focused, and the last one we're going to talk about some more operational concerns. Oops, awesome. Okay, so number 1, mission alignment. So stepping back, the sponsored project is operating under the sponsor's 501c3 status, even under the grant-regrant model. Therefore, the sponsored project must operate in a manner that's consistent with the sponsor's governance documents, and that's consistent with the sponsor's tax-exempt status generally. And these are sort of 2 separate questions. So for example, if your organization was incorporated for the purpose of feeding the hungry, you cannot fiscally sponsor an organization that operates a school because the organization's governing documents do not authorize such activities. And you can't operate a commercial grocery store because that's not consistent with the work of a tax-exempt charitable organization. That's not going to pass muster with the IRS. Okay, next slide. So let's delve into those ideas a bit more. This corporate purposes issue. So corporations, including nonprofit corporations, are formed with specific powers and for specific purposes. The first step to forming your nonprofit is to draft your articles of incorporation and your bylaws and to file them with the state. So when you did that, the question to ask is, do your articles of incorporation allow for fiscal sponsorship? A common kind of workaround or solution to this corporate purposes issue is that articles can include a catch-all provision which enables the corporation, the nonprofit, to engage in any 501c3 exempt activity. And so we have sort of template language there that you can see. And these are pretty common in the articles of nonprofits. And so they empower your organization to act very broadly. So that's good. Your articles might be set, so you should check your articles and see what they say with respect to your corporate purposes. But the second issue is on the IRS side. So first of all, and this is sort of obvious, is that the sponsored project must itself have a tax-exempt kind of consistent purpose. Even though it's not going to be applying to the IRS right away for its own tax-exempt status, you have to make sure that its activities fall within a tax-exempt purpose. But for the sponsor, you also need to give the IRS notice that you're going to be participating in a fiscal sponsorship agreement. The idea here is that organizations, nonprofit organizations, describe specific purposes and activities when they apply for 501c3 status. They do that under Form 1023. The IRS grants those organizations tax-exempt status after reviewing those specific purposes and activities. So the question to ask is, did the IRS get notice that you would be engaging in fiscal sponsorship activities? And we should point out that fiscal sponsorships can, in and of themselves, be considered a new program or activity for your nonprofit. So if the sponsored project is not consistent with Form 1023 at the time when you filed it, so if the IRS does not have notice that your organization plans on engaging in this type of activity, your nonprofit will have to disclose the new activity on its next Form 990. What this does is this puts the IRS on notice, saying, hey, we've started this sort of new program stream, we're getting into fiscal sponsorship. It gives the IRS an opportunity to object if it believes that fiscal sponsorship is not consistent with your nonprofit's tax-exempt status. Now, there might be cases where if you're just doing a one-time, kind of one-off fiscal sponsorship, and it's completely consistent with what the sponsored project is doing is completely consistent with the mission of your organization, then you might not need to inform the IRS. You can argue that this is consistent with your mission and it's also consistent with your pre-existing activities. You know, we exist to advocate for the homeless, and this project is a project that advocates for the homeless, and we're going to support them. It's all consistent. But if you decide to sponsor a number of sponsored projects, or if fiscal sponsorship becomes an important area of programming for your nonprofit, then that is something that you should give the IRS notice about. Okay, so what's the board's role in all of this? Well, we have to remember that the sponsored project doesn't have its own board of directors. It's the sponsor's board that is exercising these oversight functions at the end of the day. So the sponsor's board should review and approve each project to ensure that it will be consistent with the nonprofit's corporate purposes and with its tax-exempt status. And the decision to support the project should be memorialized via a board resolution. So the board should define eligibility criteria for sponsored projects, or it can create a standard application process that will help it to screen and select appropriate projects. The idea here is that if the board is going to be exercising oversight and control over these sponsored projects, it's got to have the capacity to perform that role. And we're talking about the time and energy and resources to perform that role, but also subject matter expertise. If you're fiscally sponsoring projects that are in a totally different space and that the board and your staff don't have the substantive expertise you need to provide meaningful oversight, you shouldn't be taking on that kind of project, because you're not going to be able to discharge your responsibilities and your role as the sponsoring organization and as the board of the sponsoring organization. So that takes us to our second big topic, and it's called variance power. So let's remember that the donor's ability to claim their tax deduction is the product of the sponsor's 501c3 status. So the sponsor is ultimately accountable for the use of donated funds. This means that the sponsor has to ensure that funds are only used in furtherance of its charitable purpose. This is a major sticking point for the IRS. So To ensure that the sponsor is financially accountable, the IRS requires that sponsors maintain discretion and control, those are their words, over the sponsored project fund. This prevents the sponsor from becoming a conduit for donations, as we talked about before, or from becoming just kind of a way to channel contributions to private beneficiaries. And a key element of having discretion and control is to have something called variance power. This is the sponsor's power to divert funds that were originally intended to support the project to a different beneficiary should that become necessary. So for example, if the sponsor discovers that the funds are being used improperly by the sponsored project, the sponsor must have the ability to shut down the support. The sponsor can't be in a position where it has to fund the project in all circumstances. The sponsor also must be able to deal with situations when it becomes impractical or impossible to spend the donations in a manner consistent with the donor's wishes, such as when the sponsored project ceases operating. So that's variance power. Now, there's some kind of tricky dynamics here because the variance power means that the board has unconditional right to use the funds only in a manner consistent with its exempt purpose. So that's including the power to divert funds. But at the same time, the board cannot use the funds in a manner that's inconsistent with the donor's restrictions, with the donor's intent. This can get us into trouble if the board can't reconcile these two requirements. In these cases, the board has a few options. It can return the donation to the donor. It can get the donor's permission to redirect the donation to another purpose or organization. Or if it can't get this permission, but it wants to hold on to the donation, that it can't get permission because the donor can't be located or is no longer available, the organization can seek permission from a court to redirect the donation. The best way to get around this issue or to preempt this issue is to get consent from donors by clearly informing the donor of the sponsor's variance power at the time of donation. So on this next slide, we have some sample language for how you might do that. So the first one's sort of a generic one. As XYZ program's fiscal sponsor, XYZ sponsor retains full discretion and control over the funds, including the unilateral right to redirect funds to a different beneficiary if the program cannot accomplish its charitable mission for any reason. That's a very broad statement of the sponsor's variance power. You could have something like that. If you want to kind of provide more assurance to the donors that the funds will be redirected to a similar kind of project, you could narrow the scope of your variance power notice. You can say that we are going to redirect the funds to a different beneficiary but conducting similar charitable activities, or to a beneficiary that works on the same issue, or to a beneficiary that works in the same location or that serves the same clients. You can fiddle with the language here, but the key is to let the donors know that you have this variance power in your back pocket. The second example is sort of a real-world example from Habitat for Humanity. Habitat shall make every effort to use funds as designated. Nevertheless, under the discretion of the board of directors, Habitat for Humanity retains complete control over the use and distribution of donated funds in furtherance of its mission. So that kind of statement is going to get the job done. Okay, so topic number 3, fundraising. Who's in charge of fundraising? We want to emphasize that because the sponsor is ultimately responsible for the donated funds, it's also primarily responsible for fundraising-related issues. This ensures the maximum amount of transparency to the donors. We don't want to give donors the impression that they're donating directly to the sponsored project. We want to, in every case, make it clear that this is a fiscally sponsored project and that and what the identity of the sponsor is. But there's a second consideration here, and it's that the sponsor holds the state-level charitable solicitation registrations. So it has to monitor and control where solicitations are being made. So a bit of a primer here. Most of you know that the majority of states, including DC, Maryland, and Virginia, have charitable solicitation laws. You have to register before you're allowed to solicit money for a nonprofit. And solicitation is broadly defined in these statutes. So in DC, it's any verbal or written request for contributions that are either direct contributions, so donations or a grant application, or indirect. If you invite people to a fundraising event or a benefit event or any other way that you're soliciting money for your organization, that falls under the scope of charitable solicitation. And the consequences for violating charitable solicitation statutes can be a fine per solicitation. So that's why the sponsor has to exercise pretty tight control over what the sponsored project is doing when it comes to fundraising. You have to know where the project is soliciting funds. If it's in a state where you don't have a charitable solicitation registration, you're either going to have to register there, or you're going to have to instruct the project to not solicit in that state, for example. So on the next slide, we have kind of a list of examples of what the sponsor is responsible for. The sponsor should fundraise only in the sponsor's own name for the benefit of the sponsor project, or note on all fundraising materials, maybe at the bottom of a web page or somewhere on a fundraising portal, that the sponsored project is being fiscally sponsored by the sponsor. The sponsor should review and approve all potential fundraising sources. This gets to that geographic consideration I was talking about. Should review and approve all fundraising materials, require that checks be made payable to the sponsor. It should acknowledge charitable contributions in its own name, execute grant agreements and other funding commitments in its own name. The sponsor should take responsibility for grant compliance and reporting, although you can get assistance from the sponsored project there. You can get the sponsored project to provide you the information you need to make first drafts. And finally, ensure that fundraising by the project complies with the law, including various charitable solicitation statutes. Okay. So, topic number 4 is financial and programmatic oversight. The takeaway here is that you can't just sort of set it and forget it, and you have to provide ongoing monitoring and oversight. The idea is that even if funds are intended for the sponsored project, the sponsor is liable for financial misconduct involving the donated funds, including expenditures that are for non-charitable or non-exempt purposes, excess benefit transactions or transactions that result in private inurement, or transactions that support political intervention or other prohibited activities. These are all expenditures that 501c3 organizations are prohibited from doing. And if your sponsored project commits some sort of misconduct, that's going to be imputed onto the sponsored organization because you're the one with the 501c3 status. Also, unless the sponsored project is a separate legal entity, the sponsor can also be liable for the project's financial liabilities. So you want to make sure that the sponsored project is spending its money responsibly and is not getting itself into debt, because those liabilities can become your liabilities. And so for these reasons, ongoing monitoring and oversight is essential. So on the financial side, one of the biggest controls that you can put in is to write categorically prohibited expenditures right into your fiscal sponsorship agreement. So make it clear that there's no political intervention allowed, no non-charitable spending allowed. And then you can implement other financial controls, and that's a little bit more fact-specific. It depends on the status of the sponsored project and the extent of your relationship. If it's a directly sponsored project, then all the bank accounts should be in the name of the sponsor. And this is another area where directly sponsoring a project actually makes the sponsor's job easier, because it's easy to oversee financial activities if it's your own bank account. To give the project a little bit more leeway, you can have the project staff be signatories on some project-specific accounts, or you can allot the project some petty cash. So there is wiggle room here, even though the accounts are in your name, and that might be a good way to structure that. If it's a grant-regrant kind of arrangement where the project is a separate legal entity, then they can have a separate bank account in their own name, but still you have to have some financial controls in place. For example, you might want to pre-approve all the expenditures in kind of a detailed way, or you might only want to disperse funds on demand so that you get to review each potential expenditure and make sure that it's going to be permissible. In all events, there should be kind of after-the-fact financial reporting from the sponsored project to the sponsor, showing how funds were used, and the sponsor should have the right to review and audit the project activities. That's on the financial side. On the programmatic side, same idea. If the sponsored project is engaging in non-charitable programs or activities, that's going to threaten the sponsor's 501c3 status. So you should always review the project's programs and activities to ensure mission alignment and to verify that they're being done for a charitable purpose. Some tools here are to require, again, in your fiscal sponsorship agreement, that the sponsored project submit periodic program reports, updates on what it's been doing and what successes they've had. Another tool that some sponsors use are advisory committees. So you can require the project to create a kind of multi-party, multi-stakeholder advisory committee that can oversee operations, functioning similar to a board of directors, although not strictly speaking a board of directors. This can sort of decentralize the oversight function so that the sponsor doesn't have to get involved in day-to-day oversight. The advisory committee can do the oversight, can create reports, and then relay those up to the sponsor. A special note here on the programming side is advocacy and lobbying activities. So as folks hopefully know, and we have a whole section about this on our website, so if you go to that second slide, you can see the link to our website. 501c3s are allowed to advocate on issues, and they are allowed to do a limited amount of political lobbying, and they're not allowed to intervene in political campaigns. So if you allow your sponsored project to do advocacy and lobbying activities, that can be a very tricky area, and their lobbying activities will count against the sponsor's lobbying allowance, because sponsors are only allowed to do a certain amount of lobbying activity every year. So that's something that you want to tightly control, treat it almost like a financial control. You might want to pre-approve all the lobbying that your sponsored projects do, and put hard limits on the amount of lobbying that the project can do. So definitely an area where you have to exercise some extra caution. Okay, and our last topic is a big one. So far we've been talking about big ideas related to legal compliance, IRS priorities. Those should be addressed in a written fiscal sponsorship agreement. Every fiscal sponsorship relationship should be accompanied by a fiscal sponsorship agreement. These agreements should address the legal issues that we've discussed already, like establish that there's variance power, establish what kind of financial controls and reporting requirements there are, establish other oversight and reporting requirements. In your recitals, you can note that the board has approved the sponsored project and that the charitable purposes are aligned. You can memorialize all of that in your fiscal sponsorship agreement. But the other purpose of the fiscal sponsorship agreement is to kind of address the more basic operational considerations and obligations of the parties. These might be very fact-specific, but it's all about making sure that the parties work smoothly together during the course of their fiscal sponsorship, and it's to preempt and prevent problems from arising both during and after the sponsorship relationship. So I'm going to go through, I think we got 7 sort of topics or issues that you can think about in your fiscal sponsorship agreement. The first one, and a big one, is the administrative fee. So this is a very common feature. The idea is that there are real costs involved to being a fiscal sponsor and to kind of providing the kind of oversight that we've talked about above, but also to provide all the ancillary support services that you might be providing, payroll and whatever. That's going to cost money. It's going to cost staff time. For example, you might have credit card fees because you're accepting donations using credit cards for the sponsored project. There might be direct and indirect costs associated with employees. You might have to buff up your insurance coverage and buy insurance premiums to provide coverage to the sponsored project. You might have to get new charitable solicitation registrations because the project is soliciting in a new area. So all of these are going to be covered under your administrative fee. This is generally calculated as a percentage of the gross receipts intended for the project. We see them between 5 to 15%, but you can go above or you can go below. Some fiscal sponsors do it for free. You could also consider a minimum flat rate just to cover your expenses, even if the project isn't getting new funding. So some caveats here. First of all, you got to make sure that the administrative charge is consistent with donor restrictions. Your grant request should include the administrative fee in the budget, or the sponsored project needs to use other unrestricted donations to pay the fee. And the sponsor should stipulate that the fee, can stipulate that the fee only covers these overhead indirect costs and that direct costs will be charged to the sponsored project's funds. So if the sponsored project is responsible for getting its own insurance, that's going to become a direct cost to the project, and that's something that the project will have to pay for, not the sponsor as part of the fee. So a second one is that we see sometimes is a fund or activity balance requirement. The sponsor requires that the project maintain a minimum level of operating funds or that they engage in minimum level of charitable activities to ensure that the sponsorship just doesn't linger there in name only. This could subject the sponsor to liability. You've taken on the charitable project because it's going to be consistent with and maybe advance your own mission. If the sponsored project isn't engaging in charitable activities and doesn't have the funds to do so, that's going to raise red flags. The third point is hiring of personnel. This is one area that really should be subject to sponsor approval. The sponsor project shouldn't be hiring its own personnel without running that by the sponsor first or without having the sponsor in charge of the hiring process. Practically speaking, that's because, especially in a direct project relationship, the employees are going to be covered under the sponsor's HR policies, and the sponsor is going to be responsible for payroll and tax withholding and other responsibilities like that. So the sponsor needs to know who's on the team. But also the hiring of personnel is just a big financial and programmatic decision for a sponsored project, especially a smaller or a new project. So in exercising oversight and control, part of that is oversight and control over employment decisions. That makes sense. Here's an interesting issue. New intellectual property or other property that's created during the course of the fiscal sponsorship. Who is the owner of new IP or other property that's created during the course of the sponsorship? So if the sponsored project creates logos or publications, or if they start to amass a donor list, who owns that kind of property and who has the right to use the property both during and after the sponsor relationship is over. That last point is very relevant for donor lists. I mean, the sponsor has taken on the sponsored project because they have aligned missions. The sponsored project might get donors, and because the sponsor is responsible for taking in those donations and acknowledging them, the sponsor is probably going to know what the donor list is. And is it okay then for, during the sponsor relationship or after the fact, is it okay for the sponsor to solicit those donors? Maybe yes, maybe no. If yes, when and how? And if that's not something that the sponsor project wants the sponsor to be allowed to do, then you should address the fact that the sponsor should be segregating its donor lists and not soliciting the people on the sponsored project list. So the fifth issue is sort of related, is the use of existing intellectual property. So we can do this. The idea here is that it could be a good idea to license the use of marks or certain IP for specific purposes. So if the sponsored project gives the sponsor permission to use its logos on its fundraising materials ahead of time, this can just, this can lessen some headaches later on down the road. So that's an issue that you can address. Six, this is a big one. Include some thought about risk management here. So you can include a requirement for both parties to carry their own insurance, or you can have an agreement for the sponsored project to be covered under the sponsor's insurance. If you're going to put that in your sponsorship agreement, make sure that that's something that, that's reasonable and feasible. You're going to have to sit down with your insurance broker and talk about what extending coverage to the sponsored project would really entail. What would that cost? make sure you have a clear idea of what that commitment really means. If the sponsor and the sponsor project are separate legal entities, it's a good idea to have no agent clauses in the agreement that really clearly separate out the liability, basically saying we're only responsible for our own activities and we're not going to be liable for the other parties' activities. Related idea is indemnification provisions, saying that we will indemnify you for our activities perhaps, but not your activities. Keeping those as separate as possible. That's risk management. And finally, the last point that we'll talk about are exit and termination provisions. So it's a good idea to define the conditions when the fiscal sponsorship is going to be over. Some common ones that we see are when the sponsor project receives its own 501c3 status, or if it hits certain financial or growth thresholds. Some fiscal sponsors probably might only want to sponsor projects that are in the early kind of growth stages. If they go over, let's say $100,000 in gross receipts, the project itself might have the resources at that point to become independent, and also the sponsor might not want to have a project of that size on its books with that level of complexity, in its portfolio. That's something to think about. The agreement can just terminate on a pre-specified date, perhaps with an option to extend. That's definitely something that we recommend. This just means that the parties have to come together periodically, review the relationship, and get buy-in again, saying, yeah, this is working, this is good, we'll extend it, or maybe now's the time for us to cut it off, for the sponsor project to move on, we can end it. And finally, just upon notice, and we generally recommend that there be flexibility in fiscal sponsorship agreements, and that the parties can end it simply with notice. This, maybe the fiscal sponsored project wants to move on to a different fiscal sponsor, or maybe, they're a new incubating project and they decided that they don't really have the capacity to grow further and that it was a fun experiment, but they want to close down operations. It's a good idea for the project to have the flexibility it needs to terminate the agreement and for the sponsor to do so, vice versa. Okay, so here's some helpful resources if you want to do some more reading on this topic. GrantSpace has a really great knowledge portal about fiscal sponsorship with some Q&A questions. There's the National Network of Fiscal Sponsors. They do an About Fiscal Sponsorship information page. We found that really useful. And there's also a fiscal sponsorship directory that lists some major fiscal sponsor organizations across the country. So these are good resources for you to check out. Okay, so thank you. That's the end of our sort of presentation. Let's see if we have questions. Give me a moment to tee things up. Okay, so here's the first question. When we say a separate legal entity, what makes it such? So, there's different legal entities that the sponsored project could take. It could incorporate as a nonprofit corporation, just like the sponsor, but by filing articles and bylaws with DC or with another state, but it might just not have 501c3 status from the IRS. These are two separate procedures. Maybe that's where the sponsored project is. Sometimes with the smaller beneficiaries, like artists or documentarians or something, they can form a LLC, they can form a limited partnership. They can pursue one of these other corporate forms that small businesses or that other corporate entities seek. And that means that they're not eligible to become 501c3s necessarily, but that's the reason that they're seeking fiscal sponsorship, because this is a way that they can get those tax-deductible donations. And finally, there's also an option of becoming an unincorporated association. In DC, for example, that involves drafting articles of association. They're similar to articles of incorporation. There's just a bit less formality in that process. So that can create a legal entity for the sponsored project. Okay, let's see. Second question was, so if you're lacking a fiscal sponsorship agreement, would one be inferred if an issue arose? I don't know the exact answer to that question because I haven't really seen the real world case where that comes up. Obviously, if you have kind of verbal or oral agreements or a pattern of practice throughout the course of your relationship, then that might be drawn upon to define kind of what the terms of the agreement look like. But obviously, there's going to be a lot of fuzziness if that's the case. So that's why we would always recommend having a written agreement that stipulates these terms. Yeah, but that's a good question. I'll think about that. Okay. Can you suggest some organizations that are re-grant models for international projects? That's not a space that I've looked too heavily into, but the example that we had on the slide, Global Giving, definitely qualifies as a kind of re-grant example. They screen and partner with international NGOs or charitable groups, and then donors donate to Global Giving, and then Global Giving takes those donations and re-grants them out to their project partners working abroad. So that's sort of how that relationship would look like. I'm sure there are other ones around. Of some of the disaster, a good example are some of the disaster relief initiatives. I talked about the Hurricane Harvey initiative, but for relief for Hurricane Maria or for some of the other natural disasters that we've had out in Asia, very often it'll be a U.S.-based. It could be it could be a U.S.-based disaster relief organization like the Red Cross or a special purpose entity that's set up for this that accepts the donations, and then they will not actually perform all the recovery and the rebuilding work themselves. They'll re-grant those funds to entities abroad who are working locally to address those issues. Where are we here? Okay, let's see. What if an entity is somewhere between a sponsored project without its own board and a re-grant incorporated organization? So it's an unincorporated organization with its own board of directors and bylaws. What consideration would the sponsor and sponsor groups want to keep in mind? Yeah, so this is sort of on the operational side of things, and that's sort of what I was sort of noting in the beginning, is that most of these considerations are going to be on the operational side, on that sort of things that you would address in your fiscal sponsorship agreement. So if the organization has its own board and bylaws, that might affect who has oversight responsibility and who has reporting responsibilities to the fiscal sponsor. That's a good example. In those cases, because there's an extra layer of oversight there, maybe the sponsor can rely on the board to provide direct reports and can exercise its functions that way. So the kind of it'll affect the nitty-gritty of how the sponsor and the sponsor project communicate and how oversight works, but the sort of meta considerations are still going to be the same. What have I missed? Yeah, okay. So I'd like to hear more related to intellectual property. When creating new assets as a sponsored project, should the terms be outlined in the fiscal sponsorship contract as to who owns that intellectual property? Yes, definitely. You don't want that to become a thing that the parties fight about after the fact. If a project just creates a logo, and then afterwards the sponsor wants to use that logo or other marks, you want that to be clear ahead of time. Intellectual property is one of the areas where it's extremely useful to address in the fiscal sponsorship agreement. When it comes to ownership of sort of project, ownership of what's created during a project, let's say you have a fiscal sponsor that sponsors documentaries, and the sponsored projects are creating documentary films. Typically, the films would belong to the sponsored project. It would look more like a grant, kind of re-grant arrangement. And that makes sense. I mean, you're gonna have a hard time finding fiscally sponsored projects that will agree to be sponsored, but then once they make a film, it becomes the property of the sponsor. That's not going to be in their best interest. But we've also seen sponsorship agreements that say in those circumstances, if the film becomes commercialized or distributed, maybe there's a payback provision where the sponsored project will have to pay, a certain amount back to the sponsor to cover costs that were incurred during the course of the fiscal sponsorship. That's something that you could think about doing. It could also be a good idea to stipulate limits on the commercialization of created products by the sponsored project. So let's say you are sponsoring a project that does sort of education on a particular topic, and they end up creating a textbook, and they want to go out and commercialize the textbook. It ends up being, very successful. That's probably okay, but you don't want to sponsor a project that is in the business of creating commercially successful textbooks, because that's going to come closer to being a non-exempt activity, and that kind of income could be problematic for your organization. And there was a case where a fiscal sponsor got in trouble because they were sponsoring what was at the end of the day a commercial enterprise. So that's definitely something that you'd want to avoid. Okay, can the sponsored organization set a percentage of the amount of the donation they receive from the fiscal sponsor? Set a percentage of the amount of donations. So what I think this question is can the sponsored organization sort of set what the fiscal sponsorship fee is? If that's the question, sure, that could be a collaborative sort of process to figure out what the right amount of the fee is, especially if your organization is new to getting into fiscal sponsorship, and we get this question a lot. The question is like, what is the fee going to be? And that's a really hard thing to answer, and that might be something that can only be determined after some collaboration and after some real sharing of information about, okay, what are the in-house capabilities that I already have? Is it going to be super burdensome to include this sponsored project under our kind of HR apparatus, for example, or is that going to be relatively easy to do? Maybe we're a slightly larger organization and we have the flexibility to do that. So deciding what the fee is, yeah, it can be a dynamic process. You can change the fee throughout time. Something that we've seen in template fiscal sponsorship arrangements is to have some of these operational terms, including the fee, be set out in a separate attachment in an appendix that allows those terms to change more flexibly. So you can say in the agreement there's going to be a fee. The fee is going to be defined in Appendix A, and then you can amend Appendix A as necessary. Okay, so so this question, let's say we have a consortium, so one of these kind of collaborative models. If dues are paid by the consortium members to pay for the consortium's expenses, would they be considered donations? I think that would really depend on what the agreement is between the consortium members. Because one way that you could do this consortium is that you could have all the members be fiscally part of this fiscal sponsorship apparatus, and you can maybe have those fees structured as the fiscal sponsorship fee to keep the consortium going. But if you don't have that kind of formal agreement between the different members of the consortium that they're formally part of this fiscal sponsorship arrangement, then maybe they could look like donations. That's another question that I'm not too sure about. That's interesting. Okay, great. Thanks so much, everyone, for coming today and for listening to our webinar. Again, my information is on this last slide. My email is jqu@dcbar.org. If you have additional questions about fiscal sponsorship, or if questions occur to you in the next few days or during the course of your work, feel free to shoot me a line, and we can talk about it. Okay, great. Thanks, everyone. Have a good afternoon.